Hey, Alpha fam, welcome back to another episode of Alpha Commission. Today I've got a good one for you. We're going to talk about just, some of the pain in the charts right now and also some of the issues coming up on the schedule of, economic events, things that are kind of weighing heavy on the market right now, why we might be seeing these ups and downs. Of course, we did have the bad news, quote unquote bad news this week where, Bitcoin and stocks took a pretty strong pullback because we had stronger than expected, labor and employment numbers that had come out via, these popular surveys which have been conducted for years and which industry relies on. And then also we had, a similar type of survey actually economic data on manufacturing, which indicated that in the six key industries in the U.S., manufacturing is still going strong, and all of that suggests a robust economy, an economy that may still be overheating in the midst of all this inflation. And of course, more jobs competition means higher wages, and strong manufacturing, demand for manufacturing means higher prices. And so until the economy cools off, the Federal Reserve is probably going to continue to increase interest rates. And this stands in contrast to the news that we got last week, which allowed us to have, that real, nice pump. It wasn't anything too special, but it was a nice relief rally considering that we had had only downside pretty much for for the previous 2 weeks. So we had a nice pump, a nice relief rally. We're not 100% sure if that's over yet. We've had a pullback. It doesn't mean that we can't have continuation. So we're just watching the charts, seeing what's going on, looking at the economic news. And tomorrow we'll get more information about those employment rates as well as the average hourly earnings and the labor force participation, et cetera, et cetera. One curveball is that the Federal Reserve's vice chairman, Lael Brainerd, will be speaking tomorrow. Not sure which event he's going to be at. I just know that he tends to be one of the more hawkish ones on average, and so he might spook the market just a little bit. So just something to be aware of as you think about, what's going on in the bigger picture. And of course, most things in the world are traded in dollars, and so so goes the US economy, so goes the world, right? So it doesn't matter if you're looking at stocks or crypto or international trade, all of these things, the dollar really matters. So let's take a look at the dollar right now. You can see that the dollar is having a nice pullback. It did pump temporarily yesterday, which did correspond to that retraction in the market. But we do see the dollar pulling back a little bit more, suggesting that perhaps it has put in a top, or at least, it may settle around these lows, this kind of support area, before it continues on its way, if it does. So maybe we do, squeeze out another week of bullishness in the markets if we can get the dollar off of our back for just a little bit longer. You can see even this small increase from 101 to 102 did put some burden on the market, and today we're seeing that pressure being relieved, and you're also seeing the market you know uh, not really bullishly moving forward, but at least holding steady in most cases, if not having little baby rallies. And on the VIX, you can see, the VIX, the volatility index has continued to come down since these highs that we put in over here in early May. And so this has also provided relief. There has been some big ups and downs in the volatility. Of course, higher volatility is bad, lower volatility is better for trading. And, this lower area down here I've marked off is just kind of the Goldilocks zone. Anything under this golden line here is pretty good trading, and then of course anything above it towards this red line is just disastrous for markets. So the fact that we've been hanging out in those areas is just bad for us. You can see this kind of curve to the upside. That's not necessarily going away, so we might actually end up bouncing in these areas and coming back up here, or perhaps sideways. Not sure yet, but these things can happen. So just keep your eye on the VIX, because that volatility could influence trading significantly, depending how volatile markets get. If we jump over to the NAS 100, of course, we do see that the NAS just continues to follow my LARP lines. I didn't really expect that pullback, but you know what? Just thinking about it, of course, there should be pullbacks as we pump. And so, it just continues to follow the path. I really don't think that we're necessarily going to get, over this area. Maybe just start to curve around, around here, maybe the red line, maybe these gold lines. But I just see a lot of resistance in this area, and I personally am doubting that we're going to get past this particular threshold of 13,800. So I do see the turnaround coming pretty soon. And of course, that will drag technology and crypto with it, because the NAS 100 does lean on that tech side. And so, if we can squeeze something out of this market, hopefully it can get done in the next few days or so, maybe the next week. But really, I do expect that this is just a relief rally and will, come back down as I've marked out here, perhaps even testing these lower levels before we start to find a true floor to bounce off of. And of course, we also have the CEOs of major banks who don't normally put out bearish news. Their job is to actually be pretty bullish. And so, because they want economic activity, right? And so these guys are putting out dire warnings that there could be 15%, 20%, 35%, even 40% drops in the market left. And, if you're talking about crypto, you can almost double that, which would be just insane for Bitcoin, and it would just destroy altcoins. But for the stock market, that would also wipe out, a decade of gains, well, almost. I mean, it depends where you're measuring it from and which index you're on, but it would wipe out a significant amount of gains, and we could end up in these areas, perhaps even lower, if those forecasts are true. Now, why would they be exaggerating about those things? I don't know. Maybe to try to spook the market to get the pain over with early. Maybe they don't like to see relief rallies. I don't know. There could be some politics involved. There could be some trading, insider trading and things like that in people who publish these type of articles to try to manipulate the public. But in general, you don't usually see these warnings coming from big banks like Bank of America and Citibank and all these banks who are just putting out kind of dire forecast, really, so that even if we do have bounces, they probably won't last. But whether the politics holds up or not, I don't know. We do have elections coming up, and so it's a rock and a hard place. We'll find out. Does inflation or politics or the stock market win? Like which we have the battle of the behemoths, right? The whales, right? The politicians, the the inflation hawks, and then also, of course, the stock market. So all these guys have different interests, and then you throw into the mix international trade and energy and all of these things, and it just gets very complicated very fast. So please don't blame too many people that you're, following or listening to right now, whether that's me or other people, about the decisions that you make, because we've underscored, I think, plenty of times by now. It took a while for a lot of the other influencers to get on the same page. They were just in dramatic denial, and they keep thinking that there's just going to be a crazy bull run. Those guys are a little bit cuckoo. But once everyone came to terms with the fact that we were in a bear market, then of course, you basically are taking your risk, right? You're basically taking the risk and you're making that decision. So don't blame anyone else if you're going long in a down market. That is the risk that you're taking, and you should have profit taking strategies as well as stop losses. So, can we approach, you know, can we approach these previous highs, on relief rallies? Yeah, absolutely, absolutely. So who knows? Let's see how it goes. We also have the Fed decision on June 15th, and we also have, the CPI data for inflation on June 10th. So keep an eye out for those things. If we just go through some of these charts, of course, it's basically, I've categorized them by the index, but it's basically the same thing. You can see we're approaching pretty significant resistance on most of these charts after a pretty good pump. So can we break through here and maybe take out, one more level? Not sure. The market seems to want to have this rally before the Federal Reserve makes their decision. So now is their chance, right? Now is the chance for the bulls to have this rally. And you can see this rally is really good. Um, most of these things are starting to poke through, or they're at least bullishly oriented. And so lots of opportunity on the chart for potentially higher prices. Um, Not sure if they're all going to make it, but at least the bulls are showing some energy right now, and so this relief rally could be a little bit more sustained than what we thought yesterday as things were sinking down. Of course, the industry that was hit the hardest was probably crypto. If you look at Bitcoin, you did see it just got shot all the way back down. And what that signified really was that we're in a risk-off environment, right? So people aren't taking risk right now. Bitcoin is one of the riskier assets compared to stocks. And so if you're holding Bitcoin, you're probably going to sell it first if you're worried about the volatility in the market, right, and how shaky things are. We are just kind of middling back in our range. This isn't anything too traumatic. Of course, we do have some lines down here if you want to consider potential places where we could find support. I've marked some out. We also have our fibs, which we've been playing along with pretty well. So from this low here, we ended up coming back to the golden zone. There's the little wick right there, right lining up with the golden zone. From that bounce, we actually ended up hitting, the golden zone here. I should probably just pull these back. So this wick, we got the golden zone, and then we came up here. Got to pull back to the golden zone, seeing a bounce. And can we reach this golden zone, this next golden zone that's going to be up here around 31,500? Well, Bitcoin would have to. If it wants to stay bullish, it's going to have to break above 31,500. Right now, we do seem to be getting a rejection or perhaps a pullback. But I think this is really going to depend highly on what stocks do right now. Most of them do look like they're kind of poking their heads up to the next level above them. So if stocks can just manage to squeeze a little bit more energy, out of the system, perhaps with Asia seeing the bullishness on the US and Western side, then maybe Asia can pump us just a little bit more and get Bitcoin over that hurdle so that it can continue on a bullish path. However, we do have a lot of resistance in this area, so you know, it's going to take a lot of work to get beyond that 32, 33. And I just wanted to point out, of course, that just because we have that CME gap, around 35,000, it doesn't mean that we're necessarily going to fill it. Um, it's hanging there as low fruit, but it can also be kind of trappy. You can see this type of formation that we're putting in right now is very similar to what we put in summer, but also here at the end of December, right? So we kind of had this downward chop and then a pump up, and then we continued to chop downward and then just broke down dramatically. That's why I have these green boxes here because, I would expect perhaps 26,000 or even lower, depending on, what the news is exactly that sends us down. Let's go ahead and just put those lines back on so you can see. If it's 25,000, or 26,000, that's also a possibility. Um, Kind of lining up with that wick that we've had previously. Maybe the bottom of this support area. So these are just ideas. I honestly have no idea where it will drop because this is just very thin price action over here. And I can just suggest that we might fall into this zone. And then we might want to grab it a little bit higher than this zone. Or if you want to be really conservative, we've already broken down here. And there is a little bit of consolidation, so maybe we could catch that again. If we do break down dramatically, then the bottom of this area, like this little layer here, it lines up with the price action up here, which might act as some resistance in our fall. And that would, of course, be that $18,000 to $20,000 that a lot of people are looking for, which might get front run. Hence, I have a higher area above that. Let's go ahead and just quickly take a look at how this price action can behave here. Um, let's go on the daily. Let's see, something I haven't used in a while. We do have this MTF EMA Cloud that I've developed. It just suggests we're still under the cloud of bearishness, so not much to see there. This one does suggest that we're still, bearishly, printing. This is just another cloud that I've developed, and so, I don't really feel too bullish here. I knew that was going to be a nice relief rally. I did not expect it to be that short, but that's very typical of these type of formations. I had hoped that we would reach that CME gap. We just didn't do it, right? The market was just that much risk off, and when stocks had a pullback, Bitcoin caught the flu, right? And many of the altcoins are just in the ER, right? Just in the infirmary with broken bones and fractured skulls and stuff. And so, I don't know how much we can count on this risk-on asset of Bitcoin and crypto having much strength or showing much strength. And that's why I would suggest that perhaps what we saw here was more similar to the end of December, where we had another leg down, which could take us into this area of $22,000, $23,000 before we print something like this, before we have a real run and get a nice print, sort of like in summer, which would be a real relief rally, or perhaps even the start of a bull market, because we don't know what could happen in a couple months, right? What else do I have going on here? Of course, again, like I just created this little system here just to quickly see how bullish overall we're looking. And while we are putting in some green candles using my method here, um, you know, we really haven't found any support, and so I would give this another week to give me an indication that perhaps some bullishness is in the market, or perhaps it's just going to break down like it did in the end of December. And then we'll really know whether this was more like summer, where we just kind of reach our lows and find some support before pumping up, or whether or not we just continue to slide down. And this kind of set of indicators that I made, I just fine-tuned everything to kind of give me that look. And here I have the candles are one indication. This HMA is a second indication. And then I have this, EMA as a third and a fourth. So I can have up to 4 confirmations just using this method, which is similar to EMAs using my EMA bands, but it is different in significant ways in that this one is a little bit more obvious ahead of time, whereas my EMAs can show me that, of course, um, we do have a similar setup as what we did in summer and in December, end of December, but you know, it can't really give me a heads up as to whether or not we've found a floor, right? We would have to start squeezing first. And so the purpose of this system that I built here is to give me that heads up ahead of time, or to show me that, we're not ready yet, even though the EMAs were oriented very similarly. Of course, the big difference here on the daily being those 200s, especially. Um, let's see if we can go to the weekly with our EMAs and just show you just how bad we do look. We're pretty far underneath the 10 and the 20, and that's never a good sign when you're underneath the 10 and the 20. So we could continue to slide as long as you're underneath the 10 and the 20. It's just not good news. When you're above it, things are looking great, but below it, it's not. And then on the monthly, we're just, we just look pretty bad, pretty bad. We're starting to have some of these crossings on the lower EMAs, and the 10 and the 20 are really threatening to pinch. When the 10 and the 20 pinch, you can see that does tend to line up with the bottom of the market. And so this suggests that we have a little bit more pain to go because they haven't crossed yet. And, also I would say that where they skirt off of each other, like here, let me remove the price action. Oops. So you see where the 10 and the 20, this is the red and the yellow one, where they just like bounced off, right? Where the 10 bounced off the 20, that actually indicated the bottom as well. So we're either looking for the 10 to bounce or we're looking for the crossover, and that should indicate that we're pretty close to the bottom, if history has anything to do with it, which maybe there could be something different this time, but that's at least just one indication. Of course, on the weekly, we have already approached the 200 EMA, which has been a place in the past where once we tagged it, it was very close, if not the bottom of the market. And since we did tag it quite strongly, we could continue to go. A lot of people look at the 200 MA as opposed to the 200 EMA, but there's no guarantee that there's a preference on that one. Okay, so maybe it's just the 200 EMA. But personally, I would expect us to come and tag the 22,000 to 23,000 and get that 200 MA. Of course, we have, you can imagine this white line extending. We have also tagged the 300 EMA, and let me just double check. That's the, yep, the 300 EMA. So there is the possibility of that 20K, still alive. And should we have some just really extreme black swan event, then perhaps we could be talking about those lower numbers. I do think that's a little bit more imagination and kind of fear than anything else. I'd rather just go by what the market has recently done, because I think that traders tend to be superstitious in the sense that they repeat patterns over and over again, like fibs and EMAs and harmonic fractals, right? Because the harmonics are just fractals uh, with the statistics behind them. And then, other things like that. So if we follow, these kind of superstitious trading patterns, then we are really getting into that area where you might want to consider DCAing in if you haven't yet, because we could actually be at the bottom and you have no idea how the politics will go in terms of the Federal Reserve. We are approaching that 26-minute point, so probably want to wrap things up here. Just to say, keep an open mind to the market. Um, Stocks can potentially have a little bit more to go. This is looking a bit toppy right here, right? It's kind of looking like this, you know what I mean? It's looking like this. It's looking like this. So stocks are looking a little bit toppy to me. And, maybe we're going to see that pullback and perhaps a bigger dump if things continue to the downside. Look for that economic news tomorrow. Also, look to see how Asia is trading to see if they want to get in on some of this bullishness or if they counter trade the market. And other than that, pretty much we're going to be listening to what the Fed Vice Chairman Brainerd says tomorrow. And, until then, I think that there really isn't that much coming up, except perhaps some consumer credit reports and some jobless claims, that kind of thing. But mainly we'll be focused on the CPI data. Okay, that was your alpha for the day. Stay safe and happy trading.